Hello, funeral directors. My name is Tyler Fraser. I hope you're having a great day. Thank you so much for joining us on this monthly webinar. Every month we're doing a webinar here at UPD Urns, and we're constantly trying to provide value to our funeral director partners, whether it be through our catalog of cremation urns or educational content like this one. And I'm so pleased to have presenting today Dan Isard from the Foresight companies. And he'll be presenting on merger and acquisitions of a cremation-oriented business. Without further ado, here's Dan Isard.
Thank you, Tyler, and it's great to be with your customer group presenting this special presentation solely for UPD Urns. I'm very, very excited about being here. Unfortunately, a webinar is a one-dimensional form of communication. But I'm going to do my best to communicate with you, and if you have questions, please reach out to me. I'll give my contact information before this seminar ends. I am the managing partner of the Foresight companies. I've been around funeral service now for 35 years. As far as my background, I have valued more than 3,000 funeral homes, 800 cemeteries, been involved consulting with almost 2,000 funeral homes or cemeteries, and about 100 vendors to funeral homes and cemeteries. I've owned funeral homes, I've owned cemeteries, I've owned cremation operations. I have helped my clients operate these businesses when they were unable to for health or sometimes regulatory compliance issues. I've been an expert witness in about 150 cases over this time, and I've written 4 books, one of which was on cremation. Feel free to let me know if you want to acquire a copy of this amazing text. My company is the Foresight Companies. Since 1987, we've been providing valuation, accounting, mergers, acquisition, securing financing. My partner Doug Gober and I have put together over $800 million of financing over the last decade to help funeral homes either acquire, expand, keep people to buy them, or other refinancing purposes. I've helped hundreds of families transfer their business to their child or their almost child, the key person. We've been involved with all levels of operations, including HR, pricing, merchandising, marketing, and compliance issues. So that's my background. It's been a very full 35 years. Today I'm talking about succession. And succession is an exceptionally complex issue. First, I'm going to talk about how to value the business. The truth about how to value the business. Number 2, identify the financial independence needs, because the only reason a person sells a business is because they want to try to be financially independent, or they've failed. I'd rather take the high road. I want to show you how to lock in your value, and I want to talk about life after the sale. But you guys are unusual. You're primarily more cremation focused than the typical brick and mortar business. So I want to make sure that you understand how to understand what makes your business different. And your business is different because goodwill value is different. Many progressive cremation-focused businesses are younger. They're not the 100-year and the 80-year and the 50-year-old brick-and-mortar business. They're the 3-year-old business, the 5-year-old business. Maybe some of you are a decade. Now, the reality is all businesses are going to be cremation-oriented businesses. All funeral homes will be cremation-oriented businesses. The public is changing. Anyone who says I'm selling bronze caskets, they're akin to a Ruth's Chris in a land of tofu eaters. Trust me, the tofu eaters are multiplying. The cremation rate in this country now is more than 50%. And most people believe in the next 25 years it will top off, much like we see in Great Britain, in the 80% range. So the age of the business is younger, the goodwill value is different, and it's different because of recurring patronage. Goodwill is a defined term. Goodwill means the expectation of continued patronage. Now, if you've only served a family one time, you don't have an expectation of continued patronage. In fact, you don't know the reason yet why consumers choose your business. If it's price, you have no loyalty to that brand, and therefore you have very limited goodwill. But if in fact you can find a way to serve families, cremation choosing families, and build that retention of patronage, now you're going to establish as much goodwill as any brick and mortar funeral home will. Pre-need is another issue. More pre-need is sold to casket consuming families than to cremation consuming families. The reason is simple. Price. 70% of the United States does not have $400 in their savings account to make an emergency purchase. How are they going to make a $5,000 purchase? A $10,000 purchase? A $2,000 purchase? Well, some people have to be price focused because they have no money to be anything else. So the pre-need consumer tends to be more of a casket-seeking consumer. But the reality is, the cremation consumer, when you ask them, will choose to prearrange. And the last thing that makes a cremation business different is the real estate. If you're providing services to cremation consumers primarily, you may be renting your real estate. You don't own the real estate. And having a lease in a cremation, having a lease in a commercial property is different than owning a property. So these are the things that make you and most of the client base of UPD Urns, who are unique, progressive, proactive people in the world of cremation. That's what makes you and your business different. So how do we value the business? Well, it's critical that you do, because 75% of your total net worth is tied up in this business. 95% of your income comes from this business. In order to have the greatest probability of a successful retirement, you have to make sure you know the value of this business and you work to maximize the value so that when you sell the business, you're going to have the greatest result. And in case you say my business won't be sold, no, every business in the United States, in the world, will be sold. Some, the creator of the business, will be alive at the time of the sale, but every business will be sold. So how do you value your business? Think about it. I'd like you to write down your answer if you can. Do you hire a qualified appraiser? Ask the casket salesman. Ask your accountant that doesn't know funeral service. Try to find out what your competitors sold for and add $100,000, or do you make up a number? Okay, lock in your answers. There's only one. Hire a qualified appraiser. Your accountant, if they do not work in funeral service, is using frames of reference like bowling alleys or dry cleaners. That's not how funeral homes sell for, especially funeral businesses that focus on providing service to the cremation consumer. In order to value a business, and I've done more than 3,000 of them, you value the tangible assets as true economic assets. That's step one. So, for example, what's the accounts receivable worth? Well, that's almost a trick question. The direct disposal business should not have receivables. You can't afford to have receivables. The real estate, as I said before, you may not have real estate. You may have a lease. If you do have real estate, there's only two types of real estate. They are either A properties or C properties. And the value is very simple. It's a percentage of your of your revenue should be your triple net lease. So if you have $100,000 of revenue in a year, a triple net lease would be anywhere from 8% for an A property and 6% for a C property. Take that triple net lease amount, multiply it by 10, and that equals the fair market value of the real estate. So, for example, a cremation-focused business where the owner owns the business and the real estate and leases the real estate through another enterprise, that rent, if it's an A property, if it's a perfect property, should be 8% of revenue. If revenue is $500,000, the rent should be $40,000. 10 times $40,000 equals $400,000 for the value of the real estate. If it's a C property with the same revenue, that would be $30,000 of rent. Times 10 equals $300,000 for fair market value. Is the real estate important? It is less important in a cremation-focused business where families may not be using your building for convocations. The most valuable cremation serving community I ever saw was on one of the Hawaiian Islands, and we valued a 1,600 square foot office space that served almost 1,600 families a year for direct cremation, services at another site, and for ship out or ship in. At the highest multiple per square foot I've ever seen in my 35 years. What do you do if the real estate's worth more than the numbers I just gave you? Well, step number one, look for a sucker. If you were stupid enough to enter into that lease, there's got to be others just as stupid. Or you close the business, sell the real estate, and relocate the business if you want. Again, families are not as reliant upon the location because they're not traveling. Whether you're 8 miles away from the place of the arranger, the arranging party, or you're 80 miles away, doesn't matter to that family. The economic value of the assets is added to goodwill. So what we have to do is create a pro forma. A pro forma estimates the next year of revenue, expenses, and results in EBITDA. EBITDA. EBITDA is an acronym. Earnings before interest, taxes, depreciation, and amortization. That's the free cash flow that someone should have before debt service, taxes. Then you capitalize that. In other words, you divide it by a risk factor. And the capitalization rate depends upon the market and the points of how your business is operated. A new business has more risk than an established business. The fair market value is adding the economic value to the value of goodwill, and that's what someone will pay you for your business. Or I should say, should pay you for your business. The fact that we have some buyers out there that are more cautious than others doesn't mean the value's wrong. Sometimes you're exposing it for sale to the wrong people. What do you do if the fair market value is too low? Well, you work to raise the value. Find the low-hanging fruit of your business. One of the things is pricing. I can tell you that cremation funeral homes, cremation-oriented funeral homes, usually think consumers choose them solely about price. It is not solely about price. It is always, at the very least, about value. Value. So amend your pricing, but be prepared to explain how your business is different than somebody at other pricing. But it is not solely about prices. Find ways to increase case count. Outreach programs, aftercare programs do an exceptional job of bonding families to you after the time of sale with that family. And therefore, they come back to you. They refer friends. It increases your case count. Find ways to cut the cost of merchandise and find ways to cut overhead. The other thing you can do is find new services to complement what you're already doing. Add more pre-need. Offer DNA services. Investigate the cost of repatriation. And add those services to your offering. See, your lifestyle as a life cycle as a business owner is changing. It's evolving. I can remember when I started to walk in this business, and today I'm like that guy practically needing the crutch. The goal is to be financially independent. Someday you're going to sell your business and you're going to want to have enough money so that you can maintain the buying power you need for your SOL, that standard of living. If you don't have enough money, it means something else. But for now, let's call it standard of living. And you want it to be for your lifetime. 66% of all people choose pre-need because they are running out of money, and this is part of an elder care program. Do you want to be one of them? You want to make sure your buying power is keeping pace with inflation, and you're going to need this money not pre-tax, but after tax. Your life after the sale is going to depend upon what you want to do. Some people never want to retire. Some people want to continue to work in the funeral home or the funeral business, and some people can see playing golf, shuffleboard, dominoes 7 days a week. I'm not here to tell you what's right or wrong. I'm here to tell you, one way or another, you need enough money. And the greatest probability of your success is based upon the business that you're going to sell. So who are you going to sell this business to? Well, I like to think of these people as the 4 Ks. Kid, key, competitor, or consolidator. The 4 Ks. And each one of these people have different tools and techniques that they need and you need. And I can tell you, after doing more than 500 transactions. They're all a little different, but they're all relatively predictable. For the kid or the key person, if you do no planning, you're going to wind up with 80%, 70%, 60% cash at closing. You're going to wind up having 20% of the sale price deferred for 20 years until the lender gets paid off. With planning, you'll wind up with 90 to 100% cash at closing, or at worst, 90% cash and 10% paid over the first 10 years of your retirement. The difference is planning. There are people out there, like me, who know how to do this planning. You need to lock in value. If you're dealing with a kid or a key person, lock in the value, because there are only three things that can happen. The seller is going to die before retirement, become disabled long-term before retirement, or retire. So if I'm you, I want to play the odds. And the odds are 80% are going to make it to retirement. But I can insure against the possibilities. Death before retirement is a 5% chance. Long-term disability is a 15% chance. I can bet the odds for retirement, but I can insure the possibilities and probabilities. And it's not just going out and buying life insurance or disability insurance. It's getting the documents in place so that in the event of death or disability, just like the 80% retirement probability, you're going to have a self-completing business succession plan with your key person or your children active in the business. Without representation, going to the consolidator or the competitor, boy, you're really up a creek. You wouldn't sell a house without a real estate agent, but some people sell a business without competent representation. They think their lawyer or their accountant, who they know from Rotary and they bury in their family, are going to be able to help them. Not going to work. These guys don't even know what the first thing is about how to handle pre-need. They don't know the usual and customary terms and conditions. All they're going to do is give you a chance for success. You want probability. Without representation, you may get 80 to 90% of the value. You may get 80% of the agreed upon price at cash at closing and 20% paid over 10 to 20 years. You may have more tax costs than you ever knew you should have. With proper representation, you're going to wind up with 100% or more of value. You're going to get 90% or more cash at closing, 10% paid over the first 10 years. And you're going to have lower tax costs. Most importantly, you're going to have more security, because we're going to make sure the questions are asked. And I can tell you, that's what we bring to the table. That's how I named my company Foresight 35 years ago. Because I knew we would bring the vision to the table that would help our clients in operations and transactions. The process we put our client through starts with evaluation. You need to know what it's worth. And don't think if I tell you your business is worth $1 million and you want $2 million, that we're going to go forward representing you. We won't. Because then in future transactions, buyers are going to think we're liars. So we start with evaluation. If you think the value is too low, then we don't go to market, but we work to pick the low-hanging fruit and add the revenue, the case count, cut the costs, so that way we can demonstrate higher value for the future. What you get and what you get to keep are two different numbers. Taxes can be anywhere from 21% to 50% of the sale price. So we need to do a tax analysis, and you get to say when you're going to pay the tax, how much of the tax you're going to pay, or whether you're going to work to avoid or defer the tax. We're then going to do a financial review. We're going to take your after-tax from the sale, look at your other assets, and we're going to make sure that you can be financially independent. If you can be, then we go to market. And we start by soliciting buyers. And before we solicit, we ask you who the buyer should not be. You know, some people say, I don't want it to be my regional competitor. That's fine. You might be making a mistake. I reserve the right to argue with you. But if that's what you want, then we will exclude them from the solicitation. But we need to vet the buyers before we begin soliciting. Then we negotiate the deal points with the buyer community. And then after we see that they have given us an indication that they're willing to pay the true fair market value of the business, now we create an interview and an on-site tour for them. Once we go through this interview, you get to choose. We'll get the final offers from the buyers, which usually go up after the on-site interview, but then you get to choose. And I want you choosing not necessarily on price. I want you choosing on corporate culture. Who is going to be the party that you're going to trust to respect your name, reputation, your family's hard work for the future? Then we go through about a 45 to 75 day period of due diligence when the lawyers are doing their thing, the accountants are doing their thing, the buyer's bank is doing their thing, and we're making sure that all the third party due diligence for title, survey, environmental, operation, regulatory compliance are all being done. And then we close. Now, if you've never been to a closing, let me tell you something. A closing is an absolute boring event. Absolutely boring. You sign your name about 140 times, and then you wait about 2 hours until a paralegal comes in and says the most inane phrase you've ever heard. They walk in and they say, the wire hit. Now, when the wire hits, that means that your money as the seller has been transferred to your account. And I'm here to tell you that after seeing this reaction hundreds and hundreds of times, you're going to have what I call a giggle. A giggle. That's not gig as in like a million or one of these internet macro terms. Giggle is the overwhelming, uncontrollable ability to laugh. Because the work you have done for the last so many years of your life are now being monetized. Giggle. Trust me, it's fun. Now, the perils, first is to do nothing. To assume I'm going to live another 10 years, 15 years, 20 years. To assume I'm going to wait until the business is going to grow a little bit more. Waiting too long to do something is wrong. Because man plans, God laughs. Don't leave it for the survivors to figure out, especially if you're remarried. Don't wait for the kids to figure it out. Don't pit kids against kids, kids against surviving spouses. The survivors fighting it out is the wrong way to do it. Now, in the almost 30 minutes that this webinar has taken place, you probably came up with some questions. Hopefully, you'll write them down. Hopefully, you could reach out to me through email or phone call. Reach out to me. Ask me the questions. We're allowed to disagree. But remember, there's a reason I call it Foresight. Because I've seen over 35 years what happens. Thank you very much, Tyler. Thank you very much for watching this. And please reach out to me if you have any questions.